You're listening to Capital Topics, episode number 52. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François, Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the following points. For our first topic, we'll review and comment on the recently launched tax-free First Home Savings Account, FHSA. And next, for our main topic, we will review the Credit Suisse Global Investment Returns Yearbook 2023. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very good, thank you.
Good. So I'll start today. So in our first topic, we'll review and comment on the recently launched tax-free First Home Savings Account, FHSA. This is a topic that we covered in episode number 45 of this podcast back in October 2022. But since then, as of April 1st, the legislation governing these types of accounts has taken effect. So we thought it was a good time to revisit the basics and give you some planning ideas.
Yes, so for many of our clients and our listeners, this is a hot topic that deserves our attention since it's probably the most significant tax break ever offered to help Canadians save money tax-free for the purchase of their home. And even better, you're going to get tax savings or deduction. So it's super interesting.
Yeah, I totally agree. So let's start and remind our listeners of the basics of how an FHSA works. The first question to ask is who can open a first home savings account? So to be able to open an FHSA, you must be a tax resident of Canada aged between 18 and 71. Furthermore, you or your partner cannot have owned a home in the current calendar year, and any of the previous 4 calendar years.
Yeah, so one interesting nuance here to highlight is that although you can only participate once in the program, if you're now renting, but you were a homeowner, let's say 6 years ago, you could still qualify as a first-time homeowner and open an account.
Yeah, correct. And once you have opened your account, you can contribute up to $8,000 per year to a lifetime maximum of $40,000. If you don't contribute the full $8,000 in a given year, you can carry forward the unused portion of your contribution room to a maximum of $8,000 per year. This means that if you contribute less than $8,000 in 1 year, you can contribute your unused amount in a future year. For example, if you open a FHSA in 2023 and you only contribute $4,000, in 2024 you would be allowed to contribute $12,000. That is the $8,000 for 2024 and the $4,000 for the unused contribution room for 2023. Also, with the RSP, your contributions are tax deductible, meaning that any amount you put in will be deducted from your taxable income, therefore reducing your income tax.
Well, that's the wrinkle, François, that really makes it different from a tax-free savings account in that,
totally.
TFSA, you don't get a deduction, everything accumulates tax-free, and then, you have no tax consequences when you take sums out. So there's an interesting planning strategy here, especially for younger people. They're just starting their careers, and they may not be earning enough money yet, but they do have enough to save and put the $8,000 in. But in future years, they're going to have higher income. So you don't have to claim the deduction in the tax year you made the contribution. So that's the same as with a regular RSP. Mm-hmm. Your contributed amount can be carried forward and deducted in a later year when, again, as I said, your income would be higher. This way you can get a bigger tax deduction for your contribution. For parents who wanting to help their adult kids to buy their first home, since attribution rules don't apply, they can give money to their kids for their contribution. So again, there's a lot of interesting planning options for young people to take advantage of this.
Yeah, exactly. And also the contribution to an FHSA doesn't have any impact on your regular RSP contribution room. So if someone is fortunate enough and has the funds available, you could contribute to both types of accounts and use a tax-free fund to contribute to your regular TFSA. There's an important caveat here, however. Once you open your FHSA, it can only remain open for up to 15 years or up to the end of the year when the account holder turns 71. at that point, if the funds have not been used to buy a first home, it can be transferred on a tax-free basis to an RSP or a RIF, or it can be withdrawn.
And again, it will be fully taxed if it is withdrawn. If it's put into the RIF, you're going to have to follow the RIF withdrawal rules that are prescribed in the tax code.
Yeah, and we would not recommend to withdraw the funds normally.
No, in fact, that's a very important point, and that's really the angle that contributors to first home savings accounts must really think about, is if they're going to need that money in a near-term period other than to buy a house, then this may not be the vehicle for you. So let me talk a little bit more about that. So as you said, the amount withdrawn would be added to your income and tax. That said, since the transfer to an RSP would not impact nor would it limit your RSP contribution, as you pointed out, François, there's another planning idea here for people who've been renters all their life. So we're not talking younger people, we're talking maybe older people. Lifetime renters that don't intend to ever buy a house and that have maximized their RSPs could open a first home savings account, maximize their contributions to it. This way, since the funds accumulated in this FHSA, it's really hard to say, and it's a mouth, FHSA, can be rolled over tax-free to a regular RRSP, and the renters would effectively be generating an extra $40,000 of RSP contribution room. And if they have significant, or high marginal tax rates, then they'll be getting, let's say, 45% or 50% of that $40,000 contribution back in tax savings. So it's really, really interesting.
Yeah, this is effectively one of the loopholes of this new program. Even then, if you are unsure whether you'll be buying a house in the future, there's not much downside in opening an account and making the contribution, because in the end, if you don't buy the house, as we've mentioned, you can roll over the funds accumulated tax-free to your RSP or RIF. So if you don't have the funds to make contribution to both FHSA and the RSP, it would make sense to put the money in the FHSA first. Talking about RSPs, if you were planning to use funds accumulated in your RSP to buy a house with the home buyer's plan, you'll be happy to hear that you will now be able to use the funds from both types of accounts. As a reminder, at first, when the legislation was introduced, you could not combine both plans to buy a house.
Well, that's a huge change, and that's very positive. Since prospective first-time home buyers could add another $35,000 of down payment.
Yeah, that's very interesting indeed. However, unlike with the FHSA, the amount withdrawn from the RSP with the home buyer's plan must be repaid within 15 years. So starting the second year after the year of your first withdrawal. So the HBP, home buyer's plan, is essentially only a way to borrow money from your RSP.
That's totally correct, François. So in any case, I would recommend anyone to open a FHSA as early as possible to benefit from tax-free compound growth. So if you open your account early and you make the maximum contribution each year, you can invest your funds, perhaps maybe a little bit more aggressively than you would have, since the account can remain open for up to 15 years before you need to cash it out to buy a home or roll it over into your RSP or RIF. So if you wait too long before opening and contributing to the account, you're giving up on growth, since you'll need to invest your funds more, perhaps a little more conservatively.
Yeah, investing the maximum early, that is $8,000 per year for the first 5 years for a total of $40,000 at an annual growth rate of 6% could result in approximately $85,000 in 15 years. If you combine that amount with the home buyer's plan of $35,000, that's a total of $120,000 in down payment. So that's a nice amount. Even then, if you have a partner that has been as diligent as you've been, you could have up to $240,000 that could be available for a down payment.
Yeah. But again, that assumes a 15-year projection, and perhaps most people want to buy a house sooner than that. So, but it is an interesting point that you make, that you will have a significant chunk of coin, because if you even without the compounding, you take, both spouses, you'd have $35,000 each, so that's $70,000 in the home buyer's plan and $40,000 plus whatever returns you would have had in the FHSA. I really have to say it slowly, otherwise I trip all over it. So yes, again, but whatever your investment goes, Francois, the key is to let the magic of compounding work for you, regardless of vehicle. So if you're sheltered or you're tax-free in your projections, it really, 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 really adds to the long-term value, and you accumulate more money over time. So again, very important to remember that. The sooner you start, the better you will end up in the long term.
Yeah, totally. For James, maybe a planning question here for early saver. Well, they often ask themselves when they are starting, what type of account they should prioritize: the TFSA, the FHSA, or the RSP. And for those starting a family, we can add the RESP. What would you recommend for early savers who have competing needs for their savings and can contribute or maximize contribution to all of those accounts?
That's a really great question, François, because as we all know, because we do a lot of financial counseling now to the children of our clients who we brought on board, and there's competing needs for their money. And so the price of houses today make it such. Interest rates have now gone up. So they've got, the RSP. What do I do that? Do I do my tax-free savings account? Do I pay down my mortgage? And when mortgage rates are at, 1.5% or 2% is one thing. Now mortgage rates at 6 or 7%, that's a guaranteed rate of return. You got to factor that in. And then, of course, you've got now the first home savings account. And then finally, you have the registered education savings plan. And we've talked a lot about in prior podcasts where we recommend the grandparents give to their children the money for that, for their grandchildren. So the answer to your question is likely to be to do your TFSA first. So if you're in your early 20s, you don't have a lot of income, but you don't know if you're finished your education, it offers the most flexibility because when you take the money out of a tax-free savings account, you can put it back in. You just have to wait to the following calendar year. But the FHSA doesn't offer that. Just like an RSP, you take the money out, you cannot put it back in. So that's, a big deal. So, but there's going to be a lot of noise from the financial press, from financial institution marketing that, wow, you're going to get a deduction, so it's necessarily better. So I'd be very cautious that you understand the real pros and cons of all three plans: TFSA, FHSA, and RSP. Again, what an alphabet soup of acronyms, eh? You remember that if you need the money 2, 3, 4 years for other than a house, and it's in the FHSA, you will have to be taxed on it. So there's no one size fits all answer. And we've had this a lot in client meetings with the children of clients who are still in university or in their 20s, and they're just starting out. So again, our bias would be towards the tax-free savings account as their first option to start off with, particularly if they're earning below $50,000 a year. But if you're sure you're going to be buying a home in the near term, then it is a really good option because perhaps your marginal rate not be that high. You may not have as high as a deduction, but everything you can take out to buy the house. So that's really the big advantage. So again, no one size fits all answer to the question. So you could even consider, withdrawing, for some people, withdrawing money they now have in their TFSA, by the way, and in their tax-free savings account, turning around and putting the money into the new first home savings account, and then getting the deduction, taking the deduction and putting the money back into the tax-free savings account in the following tax year. So again, there's going to be a lot of interesting options here for planning.
Yeah, totally. So finally, for the moment, there's only a handful of financial institutions that are presently offering these types of accounts. So it's been official that since April 1st, you can open one. So when I verified, only Questrade, the Royal Bank, and the National Bank were offering it, but other institutions will soon follow in the coming months.
Well, yeah. But lastly, François, if you're currently in the process of buying a house, since there is no holding period before you can withdraw the funds from your first home savings account to buy that house, you could technically open an account, make the maximum contribution for the year, the $8,000, and get a tax refund, and then withdraw the money and then use it for the house. So, it's again very interesting. It's very, very new. Again, a lot to talk.
Yeah, that's a very good point, James, because I think with the home buyer's plan, I think the holding period is 90 days. So here with the FHSA, there's no minimum holding period. Great point, James. Thank you.
Okay,
so our main topic today is a review of the 15th edition of the Credit Suisse Global Investment Return Yearbook 2023 Summary Edition. Our regular listeners will know we make this an annual tradition. Last year, we put a lot of effort into preparing our podcast number 38, in which we reviewed the 2022 edition of the Credit Suisse Global Investment Yearbook. And we recommend our listeners to go back and listen to it as the content, which is the impact of high inflation on stocks and bonds, and an update on the benefits of international diversification is still very, very relevant to what is happening in the financial markets now. That being said, James, could you give our listeners an intro about the yearbook and explain its purpose?
Absolutely. And again, I'm going to quote directly from the introduction in this year's Credit Suisse Global Investment Returns Yearbook. It documents the long-run asset returns over more than a century. That is since 1900. So we're talking, there's 122 years of data. A key purpose of the yearbook is to help investors understand today's markets through the lens of financial history. The yearbook details the returns and risks from investing in equities, bonds, cash, currencies, and factors in 35 countries and in 5 different composite indices. So I'd also like to mention that this Global Investment Returns Yearbook is produced in collaboration with renowned financial historians from the London Business School, Professors Elroy Dimson, Paul Marsh, and Mike Staunton, who produce the DMS database, and DMS is just the acronym for their family names. So they're also co-authors of a book they published called The Triumph of the Optimist, and it was published in 2003. So really, the yearbook is a continuation of that, just updating the data to make sure the findings are still good, and if they're not, what has changed.
That's a great book. So reviewing the yearbook is an annual must-read for us. I would add that it's also a core part of our podcast mission to share with our listeners relevant evidence-based research. So now, James, I'm going to start off today's review by asking you the same 2 questions as last year. First, why do you, as a portfolio manager, find the yearbook useful?
Okay, so François, our discipline, as our regular listeners know very well, is to invest with the investor mindset, focused on the long term. We don't want to be led astray by short-term noise in the financial media and recent financial market volatility. This challenge is really daunting, and it applies to all investors, including us professionals. We have said it often in our podcast. It's simple, but it's not easy to do. We must always be cognizant that we can fall into the trap of trying to forecast the future. This is why the yearbook is so useful to us as portfolio managers. The yearbook helps put current financial market events into context and compare them to long-term capital market history.
I agree. After all, the major economic and geopolitical events of last year, it's crucial to take the time out and look at the financial market history to appreciate the importance of risk management.
Yeah, so the 2023 yearbook, like the ones before it, François, addresses the topic of why a long-term perspective is needed to understand risk and return in stocks and bonds. The events of 2022 should have reminded investors to fear complacency. Larry Swedroe again said it well, and we quoted him in our lessons of 2022. He wrote his article, Lessons from the Markets in 2022, and his number one lesson for 2022 was, just because something hasn't happened doesn't mean it can't or it won't.
Yeah. So now my second question to you, James, what are the highlights of this year's report?
Well, I've got 5 highlights from this year's report. So, I'm going to go in order. So my first highlight is they make the case for the importance of a long-term perspective, and with it, an appreciation of the laws of risk and return in stocks and bonds. We should always remember that if something looks too good to be true, and it's outside the long-term history, then you should really pay attention and not be complacent, as I said earlier. So it starts with explaining, in the book, that even 20 years of data is too short to be helpful in making asset allocation decisions. And then most clients, aren't wired that way. That they 20 years is like a lifetime in investing, right? So I quote from the Yearbook, "The volatility of markets means that even over long periods, we can still experience unusual returns. Consider, for example, an investor at the start of 2000. You're right at the peak of the tech bubble. And then look back at the 10.5% real annual, not nominal or gross of inflation, but real annualized return on global equities over the previous 20 years and regarded this as long-run history and hence providing guidance for the future. But over the next decade after, that investor would have earned a negative real return on world stocks of 0.6% per annum over 10 years. So after 10 years, you'd have 6% less money. So again, very dangerous to use a data series of 20 years to just project that into the future.
Yeah, that's very true. And that's why it's important to be careful about recency bias. The Yearbook also talks about having a long-term perspective about bonds. What does it say, James?
Well, again, you mentioned recency bias, François. Recency bias, we think that's just what happened last year. That's
right.
Intuitively, that's what we think, right? And we talked about that in a recent podcast where we were quoting Jason Zweig of the Wall Street Journal, who wrote a wonderful article on the topic. The Yearbook makes the case for a much longer time frame. And when you look at bonds, okay, so to answer your question specifically, I'm going to share another quote from the Yearbook. "Long periods of history are also needed to understand bond returns. Over the 40 years until the end of 2021, the World Bond Index provided an annualized return of 6.3%, not far below the 7.4% in world equity." So it was phenomenal. But what happened over those 40 years, our listeners know from what we've been sharing with them over the last few years, it's been a big period of interest rates just falling. And that's bond prices go up when interest rates fall. So I believe, and the Yearbook concurs, that extrapolating bond returns of this magnitude into the future would be foolish. So the report goes on to say those 40 years were a golden age for bonds, just as the 1980s and 1990s were a golden age for equities. In fact, the real return on world bonds in 2022 was minus 27%. So you imagine you vaporized a big part of your capital in 1 year. And so 2022 has taught us a lot of really important lessons of paying attention to long-term capital market history.
Yeah, it's so difficult, if not impossible, to forecast and successfully time big market directional shifts. So in our last podcast, number 51, we addressed the active versus passive results of in 2022. The worst category out of the 20 was global real estate with a success rate of only 20%. It was slightly surpassed by the corporate bond category with a success rate of 22.6% and by the diversified emerging markets category with a success rate of 23.4%. So the vast majority of active managers missed the boat and perform poorly in these asset class compared to the regular passive funds.
That's exactly right. If those active managers could have forecasted the future, then particularly in those two asset classes, there should have been a lot more outperformance. And the evidence is just the opposite. It's worse. So again, let's get to my highlights. And the second highlight of the 2023 Yearbook is actually linked to the first one. And here it is. And I'm going to quote, "A historical risk premium in equity and bond returns relative to T-bills exists for a reason, that being a necessary payment for the risk of volatility and drawdown." By drawdown, we mean,
market's going down.
The value could drop. So as our listeners well know, we've experienced 4 equity bear markets since 2000. And therefore, we got to be paid for taking this risk.
Yeah, that makes a little sense, since when you think about the 2020 pandemic, the world experienced its third bear market in less than 20 years. Markets then staged a remarkable recovery and volatility fell once again. However, in 2022, volatility again rose and both stocks and bonds fell sharply on inflation and rate hikes, worries and concerns over the Russia and Ukraine war. This was the 4th bear market since 2000. The Yearbook addresses how portfolio diversification can mitigate such risks.
Yes, but as we know, François, reaping the benefits of diversification is also a long-term investor mindset concept, and it can let you down in the short term. Once again, 2022, a fantastic year to teach us capital market history lessons, right? The historically extreme negative returns in 2022 of the classic balanced portfolio, 60% equities, 40% safe bonds. Well, both asset classes dropped, and particularly in the U.S., this was the worst year in over 100 years for that balanced portfolio.
That's a perfect example. To me, this point was also made in last year's report, specifically that negative correlation between stocks and bonds were not the long-term norm. The yearbook makes it clear that stock and bonds have historically positive correlation, and that the last 20 years of negative correlation before 2022 was not the norm.
Again, we've addressed this topic a lot in recent podcasts. Again, investors must have a long-term mindset. So I'm on to my third highlight of the 2023 yearbook, and it's the topic of stagflation. So again, it's a word people haven't heard in a long time.
Yeah, for listener, it might be good to clarify what stagflation is. The term is from the 70s, early 80s, which characterized an economy with low growth, high unemployment, and also high inflation.
Thank you, François, for sharing that. Again, the yearbook warns that there's a growing consensus that conditions will return to normal with low inflation reestablished. So again, they quote academics Arnott and Shakurnia in a paper they wrote. A keener look at history would highlight how rare this happens. They state that if this consensus happened, then that would, in their view, be a best quintile outcome. And with the worst quintile being inflation persistence for a decade. So quintiles are just statistics, right? You're in the top quintile or the bottom or in the middle. So this is saying that's really rare that we could get back to having this low inflation around 2% if you're looking at it through the lens of financial market history data.
Yeah, well, to me, this point is about forecasting the future or trying to guess the market's prevailing psyche.
Of course. And again, let's try and avoid the trap. But the yearbook makes the case that inflation and interest rates may not come down as fast as expected on the very long-term perspective. And again, they're using the DMS database and the capital market history to say. And there's a lot of smart people that are saying, interest rates aren't going to come down as fast as people think they are. So again, there may be a consensus, and the bond market may be indicating that rates are going to come down much faster than people would think with the opposite view, but time will tell. My fourth highlight, François, of the yearbook is that they tackled a really big question. And what does it mean to be an inflation hedge? Because we throw that out all the time. Stocks are an inflation hedge, and we talked about that, a little in recent podcasts. Well, so what does it mean to be an inflation hedge? So, for instance, most investors believe that equities are a hedge against inflation, but the yearbook provides extensive evidence that stocks as well as bonds tend to perform poorly when inflation is higher. It also makes the point that both stocks and bonds perform worse during hiking cycles.
Stocks, they are not as often claimed the best hedge against inflation. The yearbooks makes a great case that returns deteriorate for both stocks and bonds as inflation rise. The yearbook also makes the case that equities perform especially well in real terms when inflation was low. In periods of deflation, stocks actually produce lower returns than on government bonds. We discussed this in last year's podcast, number 38, I believe.
Yes, we did, François, and thank you for highlighting that. The 2023 yearbook makes the point very clearly again this year about the long-run evidence on equity returns. And I'm going to quote, "While equities have enjoyed excellent long-run returns, they are not and never have been the hedge against inflation that many observers have suggested." And here's the important nuance that I think our listeners should understand, François. "Despite this," and I'm quoting again, "it is widely believed that stocks must be a good hedge against inflation to the extent that they have had long-run returns that were ahead of inflation." We've all seen those charts, bonds over the very long term, T-bills and inflation and stuff. So yeah, stocks beat inflation. However, their high ex post, that is after the fact, return is better explained as a large equity risk premium. The key nuance, and this is what's important, is that it's important to distinguish between beating inflation and hedging against inflation.
Right. Right. Financial markets in 2022 proved that point, I believe. Stocks went down in a year of high inflation. The yearbook makes the case that most finance professionals are too young to remember high inflation, bond bear markets, and years when stocks and bonds declined sharply together.
Yeah, what a great year for long-term investing lessons that 2022 was. So again,
Totally.
the yearbook provides the long-run analysis needed to place the 2022 events in context. So now I'm going to share my fifth and final highlight when the yearbook tackles the topic of commodities. And we see that one in the press, right? Financial press. So as an asset class and the benefit of holding it for periods of inflation.
Yeah, we hear a lot of noise about investing in commodities as an inflation hedge and the fact that they are not correlated to equities and bonds. What does it say about the role that commodities play as an asset class? Do they offer a hedge against inflation that equities don't, James?
Well, the answer is quite interesting, François. And again, I'm going to quote from the yearbook. A key conclusion to take away and highly pertinent today as the 60-40 equity bond strategies have let investors down. We're talking about, particularly for American investors in 2022, is that commodity futures, and we're not talking about commodities, but commodity futures do prove a diversifier from an asset allocation perspective, being negatively correlated with bonds, lowly correlated with equities, and statistically a hedge against inflation itself. And they go on to say the problem is that the limited size of the asset class cannot solve all of the global asset allocators' prevailing inflation-induced dilemma. So think of it. If it was that obvious, all the big institutional players, let's go buy that. Well, there's just not enough of it to be able to for everybody to buy into, to make it the diversifier that you need. So it's nice in theory, but not realistically investable. And again, for both institutional and retail investors, you can imagine if somebody comes up with a product, the fees would be outrageous and whatever. So again.
Yeah, James, you refer here to commodity futures, but it's also interesting to raise that the yearbook also looked at direct investing commodities.
And
what does it say?
That's the important thing, because when most retail investors or listeners are going to listen to, the noise in the financial press, and it's going to talk about commodities, and it's going to forget the nuance about commodity futures. So the yearbook findings about direct investing commodities is that they do not provide a hedge against inflation. And I quote, "We find investing in individual commodities have themselves yielded very low long-run returns." So not only is it not the inflation hedge, the actual commodities, but you get pretty lousy returns. So avoid is basically what they're telling you.
I think there's more in the yearbook that is significant. As we point out to our listeners regularly in our podcast, history can provide clues to the future. We should be cautious about any forecast.
Yes. Well, again, great point, François. The yearbook results are long-term averages spanning many different economic conditions. As discussed in the beginning of today's podcast, this is because stocks and bonds are volatile with major variation in year-to-year returns. We need very long time series to support inferences about investment returns. And we talked today about 20 years for stocks, 40 years for bonds not being long enough. The Suisse reports, again, are very helpful in seeing this.
Yeah. So James, to wrap things up, given the insights from the yearbook and given the backdrop of higher rates and high but slowly declining inflation, how should investors be thinking about their portfolios today?
Well, funnily enough, François, in preparing for today's podcast, we listened to our number 38 and looked at the script as well, and it's almost like I could repeat the same conclusion that we shared last year. So in that podcast number 38. So I think it's also important to remember that rising rates and high inflation are just two risk factors that investors face. Equity investors have experienced periods when safe assets, again, example of bonds and cash, have been good counterweights to the volatility of stocks. Has not been the case in 2022, as we know, and part of 2021. Remember, there are many different risks that you're trying to defend against. There will be times when bonds will be helpful, and I recommend that our listeners always consider their long-term goals, their risk profile, their ability to take risk, and their time horizon. In addition, they should consider, are they in a decumulation phase, and what's that plan for their portfolios? All these elements should be considered when thinking about the structure of their portfolios.
Yeah. So in conclusion, I'll quote the yearbook. Bad years happen, and when they do, it is consoling to remind ourselves of the long-run record from global investing. For investor in risky assets, especially equities, the long-run record truly does represent the triumph of the optimist.
I love that quote, François, because it links back to Dimson, Marsh, and Staunton's book they published in 2003. And in fact, you do have to be an optimist to be an investor in volatile capital markets. So again, I hope our listeners will take inspiration from it. On another note, we hope that the recent merger of UBS and Crédit Suisse into a mega bank will mean that the tradition will continue. This report is produced by Crédit Suisse's Research Institute. So again, I find this very useful, and we hope that they're going to continue post-merger to publish a yearbook of global asset class returns.
Yes, hopefully. Okay, so thank you, James, for sharing your expertise and your knowledge.
My pleasure, François.
That's it for episode 52 of Capital Topics. Don't forget, if you'd like to send me a question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on June 8th. See you soon.